Hi, my name is Buckley, Senior Vice President of Global Investments. I've spent over 25 years making decisions that move billions of dollars across borders. And I can tell you this, the most dangerous decisions are not the ones with obvious risks. They are the ones where the risks are hidden beneath opportunity. This story begins in a boardroom, a long glass table, 12 executives, and one decision that would define the next decade of our company. We were evaluating a $4.2 billion energy infrastructure project, a foreign direct investment, the kind that locks you into a country for 20 years or more. The opportunity looked extraordinary. Rapidly growing energy demand, untapped natural resources, government incentives, projected returns well above our global average. On paper, it was one of the most attractive investments we had ever seen. But I didn't look at the returns first. I looked at the country. Because in international finance, you are not just investing in a project. You are investing in a system, a political system, an economic system, a financial system, a legal system. And if that system fails, your investment fails with it. I remember turning to the board and asking a simple question. What happens if the country changes the rules? Silence. Because that question, that single question, is the foundation of country risk analysis. Country risk is not just about volatility. It is about uncertainty. Uncertainty in government decisions. Uncertainty in economic stability. Uncertainty in whether your money, your assets, your future cash flows will still belong to you. Many executives in that room were focused on revenue projections, market expansion, competitive advantage. But I had seen this before. Years earlier, we had entered another country under similar optimism. High growth, strong projections, confident leadership, and within 3 years, new regulations, currency collapse, capital controls. We didn't lose money slowly, we lost it all at once. That experience taught me something critical. Country risk is not theoretical. It is real, it is measurable, and if ignored, it is devastating. So before we discussed returns, before we discussed strategy, before we discussed anything, I told the board, we are not approving this investment until we understand the country. Because in global finance, the country is the deal. And that was the moment. The room shifted from excitement to analysis. And that is where our real work began. Let me take you back into that boardroom. The excitement was still there, but now it was controlled, measured, disciplined. Because once you recognize country risk, everything changes. I stood up and walked toward the screen, and I told them, this is not just an investment decision. This is a country decision. You see, country risk affects every major financial decision we make. Foreign direct investment, like the one we were considering, depends on one critical assumption, that your assets will remain yours. But what if they don't? What if the government changes? What if policies shift? What if regulations reverse overnight? That's not theory. That's reality. And it happens more often than most executives admit. Then I moved to international lending. Banks don't just evaluate companies, they evaluate countries. Because even if a borrower is strong, if the country collapses, the borrower collapses with it. Then portfolio investments, equities, bonds. Investors demand higher returns in riskier countries. Why? Because uncertainty must be priced. No investor accepts the same return for dramatically higher risk. Then I paused and turned to the most important point for our decision, capital budgeting. I told the board, if we ignore country risk, our valuation is wrong. Discount rates must increase, cash flows must become more conservative, and some projects, no matter how attractive, must be rejected. That's when the room became very quiet. Because now, we weren't talking about opportunity anymore. We were talking about survival. I gave them a simple comparison. Investing in a stable country like Norway is not the same as investing in a high-risk environment. Same project, same cash flows, completely different risk, completely different decision. That is the essence of country risk analysis. It forces you to look beyond the numbers, beyond the spreadsheets, beyond the projections. What could go wrong at the country level? Because when countries fail, even great companies fail with them. And in that moment, the board understood. This wasn't about chasing returns. This was about protecting the firm. And that's when I said, now, let's break down the risks. I looked around the room. And I said, let's start with the most dangerous risk of all, political risk, because this is the risk you cannot control. You cannot hedge it easily. You cannot diversify it away completely. And when it hits fast. I turned to the screen and pulled up a map. Political risk, I told them, is the risk that a government decision destroys your investment. Not weakens it, not delays it, destroys it. And it comes in many forms. Expropriation, where the government takes your assets. Nationalization, where your business becomes theirs. No negotiation, no warning, just gone. I've seen it happen, not in theory, in real deals. Then regulatory changes, sudden shifts in tax laws, labor requirements, environmental policies, all changing the economics of your project overnight. A project that was profitable yesterday becomes unviable today. Then capital controls, restrictions on moving money out of the country. Imagine generating millions in profit, but being unable to bring it home. Your returns exist, but only on paper. Then instability, protests, elections, regime changes, or worse, conflict. Each one adds uncertainty. Each one increases risk. I gave them real examples. Countries that nationalized entire industries. Countries that restricted foreign firms after geopolitical events. Countries that imposed capital controls during crises. This is not rare. This is recurring. And then I asked the question that matters most. Would you still invest if you knew the rules could change tomorrow? Because that is political risk. It is not just about today's environment. It is about tomorrow's uncertainty. And here's the key lesson I shared with the board. Political risk directly affects long-term investment. The longer your project, the greater your exposure. And our project? 20 years. That means 20 years of political uncertainty. 20 years of potential policy changes. 20 years of risk. That's when I stopped speaking, because they didn't need more explanation. They needed to think, and I could see it. The shift, from confidence to caution. And that's exactly where I needed them, because we were no longer evaluating opportunity. We were evaluating reality, and political risk was just the beginning. After political risk, I moved to the next layer, economic risk. And I told the board, this is where your projections begin to fail, because every financial model, every forecast, every valuation depends on one assumption, that the economy remains stable. But what if it doesn't? Economic risk is about a country's ability to sustain growth, to control inflation, to manage debt, to maintain balance. And when those things break, your numbers break with them. I started with inflation, rising costs, eroding purchasing power, shrinking real returns. You may generate revenue, but it's worth less. Then GDP volatility, unstable growth, booms followed by sharp declines. Your demand projections, suddenly unreliable. Then government debt, high deficits, unsustainable borrowing, which leads to higher taxes or reduced public spending, both hurting business performance. And then currency pressure, which we would discuss more later. Weak economies create weak currencies. I gave them real-world cases. Countries with high inflation, countries facing debt crises, countries struggling to maintain economic stability. And I told them, these are not rare events. These are patterns. Then I brought it back to our project. All of our cash flow projections, revenue, costs, margins, depend on economic stability. If the economy weakens, our forecasts collapse. That's when I paused, because this was the moment they understood. Even if the government does nothing, the economy alone can destroy the investment. And that's the danger of economic risk. It doesn't need a crisis headline. It works quietly, slowly, but powerfully, until one day your model no longer reflects reality. And by then, it's too late to adjust. The room was no longer optimistic. It was analytical, focused, and ready for the next layer, because we had only scratched the surface. By this point, the board understood something important. Risk doesn't come from just one place. It builds, layer by layer. And then I introduced the next one, financial risk. I told them, this is what happens when the system behind the economy fails. Banks, capital markets, credit systems, all the infrastructure that keeps money moving. When that system weakens, everything slows down, or worse, it stops. I started with banks. Undercapitalized, poorly regulated, overexposed. If banks fail, businesses lose access to financing. Projects stall. Liquidity disappears. Then leverage. Too much borrowing, too much risk, especially in the private sector. It works in good times, but collapses under pressure. And when it collapses, it spreads fast. Then capital markets, limited access to global funding, investors pulling out, credit tightening. Suddenly, even strong companies struggle to raise money. I reminded them of past crises, moments when entire financial systems broke down. Not because of one company, but because the system failed. And I told them, if the financial system weakens, we don't just face lower returns. We face operational risk. We may not be able to finance expansion. We may not be able to refinance debt. We may not even be able to move capital efficiently. Then I brought it back to our project. This investment depends on functioning financial markets, local banks, access to credit, stable funding. If those fail, our project slows or stops completely. That's when the room became very still, because this risk is often underestimated. It doesn't come from headlines. It comes from fragility, hidden beneath growth. And when it breaks, it doesn't warn you. It spreads, quickly, across industries, across companies, across borders. And in that moment, the board realized we weren't just investing in a country. We were investing in its financial system. And that system had to be strong enough to support us. At this point, the board was fully engaged. They understood political risk, economic instability, financial system fragility. But then I introduced a risk that looks small at first, but can destroy returns silently. Exchange rate risk. I told them, you can make the right investment and still lose money because of currency. I walked to the screen and showed a simple example. You invest in a foreign country, you generate strong local profits, everything performs as expected. But then, the currency weakens. Suddenly, those profits are worth less in dollars. Nothing changed operationally, but financially, you lost value. That's exchange rate risk, and it comes in multiple forms. Gradual depreciation, where the currency slowly loses value over time, or sudden devaluation, sharp, unexpected, severe. I reminded them of past currency collapses, events where currencies lost massive value in a very short time. And when that happens, returns disappear. Then I added another layer, foreign exchange shortages, countries running out of hard currency, restricting access, limiting conversions. You may have profits, but you can't convert them. You can't move them. You're trapped. Then I tied it back to our project. All of our revenues will be generated in local currency, but our investors expect returns in dollars. That gap is risk, and unless managed, it becomes loss. Then I asked them, have we adjusted for currency risk in our valuation? Because if not, the numbers we were looking at were overstated. That's when it clicked. Currency risk is not just volatility. It is translation, conversion, access, and control. And in global finance, if you don't control your currency exposure, you don't control your returns. The room was no longer asking, is this a good investment? They were asking, is this a survivable investment? Now we reached a risk that many executives overlook, but I never do. Institutional and legal risk. I told the board, this determines whether the rules even matter. Because you can have laws, but if they are not enforced, they mean nothing. Institutional risk is about trust. Can you trust the system, the courts, the regulators, the enforcement mechanisms? If a contract is violated, will it be upheld? If a dispute arises, will it be resolved fairly or politically? I explained, weak rule of law increases uncertainty, corruption increases costs, inefficient courts delay outcomes, lack of transparency hides real risk, and all of this directly affects investors. Then I gave them the key insight. In weak institutional environments, you are not just managing business risk, you are managing system risk. Then I shifted to measurement, because at this point, the board had one question. How do we quantify all of this? We use both data and judgment. Sovereign credit ratings, from agencies like S&P, Moody's, Fitch, they give us a baseline of default risk. Then CDS spreads, credit default swaps, market-based signals. If CDS spreads are high, the market is telling you something. Then country risk indices, global benchmarks measuring governance and stability. And finally, macroeconomic indicators, debt to GDP, inflation, foreign reserves, all signals, all pieces of the puzzle. No single number gives you the answer, but together they tell a story. And that's what I told the board. Country risk is not one metric. It is a narrative supported by data. And if you ignore that narrative, you are not investing. You are speculating. By now, the room understood the full picture. Not just one risk, but an entire system of risks. And the only question left was... The room was silent, not uncertain, but focused. We had identified the risks: political, economic, financial, currency, institutional. Now the only question was, what do we do about them? Because in global finance, you don't eliminate country risk, you manage it. I stood up and laid out our options. First, diversification. We don't concentrate too much capital in one country. We spread exposure, limit downside. Then political risk insurance, protection against extreme events, expropriation, government actions. It doesn't remove risk, but it reduces catastrophic loss. Then local financing, borrowing in local currency, matching revenues with liabilities, reducing exchange rate exposure. Then partnerships, joint ventures with local firms, or even state-owned enterprises, aligning interests, reducing political friction. Then contractual safeguards, clauses, protections, legal structures designed to protect our position. A layer of defense, not perfect, but necessary. Then I brought it back to valuation, because this is where everything comes together. Higher country risk means higher discount rates, lower expected cash flows, more conservative assumptions, and sometimes a different decision entirely. I looked directly at the board, and I said, this is still a good project, but it is not the same project we saw at the beginning, because now we understand the country. And then I made my recommendation. We proceed, but with adjustments. Structured financing, risk mitigation in place, higher required return, and clear exit strategies, because the goal is not just to invest, it is to survive and succeed in environments where uncertainty is real. The board voted, not based on optimism, but on analysis. That's the power of country risk assessment. It doesn't stop you from investing, it makes you invest intelligently. And that is the lesson I leave with you. In international finance, returns are never just about opportunity. They are about risk. Understood, measured, managed. Thank you for your time. I'll see you in the next session.